Hi, my name is Christopher Ng Chong. I'm the trainer for the Early Retirement Masterclass, and this is
Hey, hi everyone, I'm Cheng. I'm the trainer for the SaaS Hypergrowth Investing.
okay. For today, we're going to discuss the comparison between dividends investing and hypergrowth software as a service investing. So I'll be asking Cheng a series of questions on hypergrowth investing, and Cheng will then ask me several questions on dividends investing. Okay, so to get the ball rolling, right, I'm gonna hand control over to Cheng. I'm gonna ask Cheng, can you tell us a little bit about hypergrowth investing, and why is it not simply growth SaaS investing?
Alright, for me, why do I only go for hypergrowth investing? Because obviously I want to grow my portfolio a lot faster. Alright, and for hypergrowth investing, usually the type of growth that you're looking at is for companies that are growing their revenues or growing their market cap is like 40-50%, at least 30% CAGR, which is compounded annual growth rate per year. So with this, I believe that as an investor, I will be able to grow my portfolio a lot faster.
Okay,
Yeah.
all right. Could you give a few examples of hypergrowth SaaS stocks that you think investors might want to have a further look if they're interested?
For me, I do like CrowdStrike. I mean, that's one of the companies that I have in my portfolio. It is a cybersecurity stocks. Like now, you look at all the data that we have, or everybody's working from home. Most of us are working from home. You need your tech, you need your IT. You need to protect all your endpoints.
Okay.
So CrowdStrike is one of these cybersecurity companies that will that are actually disrupting the traditional legacy cybersecurity companies.
Okay.
Right. So they are the up and coming ones, and they are growing very fantastically. Pre-IPO, they are growing at about 100% a year, more than 100% a year.
Okay.
All right, and just on the last quarter, they are growing about 60-70% a year, which is quite amazing for a company that has achieved 1 billion in annual recurring revenues.
Okay.
Yeah.
Okay, so right now I think, at least for my students from the early retirement class, one of the concerns that they have regarding growth investing is the kind of volatility that they will have to experience on a day-to-day basis. So would you be able to share with some of the people listening to the video, how do you cope with volatility when you're investing in these hyper-growth instruments?
Yeah, the thing about volatility is this. If you are invested in equities, right, the kind of volatility that you're seeing, like 20-30%, is actually normal.
Okay.
Right? If you cannot tolerate or you cannot stomach that kind of volatility, you will not be investing in equities.
Okay.
Because in a market crash, or if you look at 2008, if you look at last year, let's not even talk about bonds. You look at your REITs, you look at any stocks that you're looking at, it was down 20-30%. So you have to definitely tolerate this kind of volatility. So of course, as for companies that is a lot more volatile, all right, you'll be able to grow faster also because it's more volatile. So basically, you need to know what is the valuation that you are buying. You cannot be buying too high, and you cannot. Obviously, you want to be buying at the lower zone. So if you know about the volatility, and if you find that this company that you've bought into, right, that it is at a fair price, even though it's down 20-30%, it is okay to average down.
Okay.
Yeah. So you must have a deep understanding of the company that you're investing in. That is how you'll be able to train your mind, right?
Okay.
If it's cheaper, why not? Everybody likes bargains, right?
Okay.
Yeah.
I like the way you talk about fair value, right? Could you just give the people who is watching the video a certain idea? How do you derive the fair value of, say, a hypergrowth SaaS stock?
Yeah. Actually, it's the same. For how I analyze any companies, you are always looking at the future cash flow.
Okay.
All right. Past performance is always like 2020 is hindsight. And what is most important is their future growth. So you do a DCA, a discount average kind of cash flow kind of valuation.
Right.
You may use your multiples. You may use your PE multiples if the company is profitable.
Okay.
Or you may use your price to sale or EV to sale multiples if your companies have not made a profit yet. So of course different companies have different multiples based on their growth. Like for example, a company that is growing at 70-80% would definitely have a higher multiple than a company that is growing at 10 or 20%. Right? So it is a given, because if you compound it over the years, right, based on that multiple that you bought, for example, I bought at a 50 multiple, and the company managed to make double the money next year.
Okay.
So in terms of the forward multiple, that company will be 25 multiple, right? It cuts by half. And if the next year again, you can grow at another 100% or 80%, your 25 multiple will be 12.5.
Okay.
So it makes it, it becomes cheaper. And investors are all very forward looking.
Okay.
Yeah.
All right. And then suppose somebody is now interested in growth investing, right? How is he going to start to find a group of candidate stocks to look at when he begins? Would you have any tips to share on how they can get like a few candidates, to add into their portfolio?
For me, of course, if you look at all the high growth companies, most of them mainly are in technology,
Okay.
in data analytics. Some are in consumer stocks.
Okay.
All right, and why is the reason why most of them are in tech is because for tech, right, they are very asset light.
Okay.
If you were to compare to an EV company, like an electric vehicle company, for example, you want to build a car, right? If your one factory can only produce 10,000 cars a month, for example, in order to scale it, you need to spend another 1 or 2 years to build another factory to produce more cars. Right? But for technology, very simple. In order to scale, for example, Zoom, it grew from like 10 million participants to 300 million participants during the COVID period. Right? They just need to up their bandwidth. Right? They just need to up their capacity. Right? And they grew so easily. And the thing is, the sales part is very easy. Right? You just subscribe online and you buy it. And that's it. You don't have to spend more money, more capital to produce that good. All right. Yeah.
Okay. So am I right to say that maybe one way for a person that wants to start with hypergrowth is to basically be aware of what kind of technology trends are available out there. They might even be able to try out some of these services themselves. So the best candidates would be something like Zoom, where
for example,
they see a trend of people actually coming in to actually hold these online meetings. Yeah. So that might be a good place to start, right?
Yes, that might be. It can be what you're using. For example, if you're using like Adobe, for example, a lot of people are using like Photoshop, Premiere Pro, or that. You can still look at Adobe. It's still growing very well. All right, or you can look at the things that you're using. Even Microsoft 360, everybody every year has to subscribe.
Okay.
It used to be that you just buy one of these boxes, like for example 2007 Office Edition, right? You can use for 3-4 years, right, until it becomes obsolete. Right, but now, right, Microsoft forced you to subscribe for it every year.
Right.
You have to use it no matter what.
Yeah.
All right. So they don't have to produce a disk. You just need to download online in the cloud.
Okay.
Yeah. The amazing thing is our internet speed is so much faster.
Okay.
Yeah.
I'm just going to ask you one last question before I let you rest and then have you turn the tables around and ask me. The last question is that, okay, if you're following this definition of SaaS, right, to select your investments, then what do you think about the games that children are playing? Like, for example, my kids like Mobile Legends a lot. They are almost addicted to it. Yeah, something like that. Yeah, is that a good place to look for like a good SaaS stock?
For me, SaaS is of course, in a technical term, SaaS is software as a service.
Yeah, that's right.
But for me, when I invested in companies, I prefer subscription as a service. So that is a revenue generating model. Right. Because subscription is more recurring, it is predictable. So as long as you see every year how many people are signing up, how many people are actually giving up their subscriptions. So based on that trend, you'll be able to tell how consistent is that revenue. So to me, it's easier to predict the future cash flow. All right. And if it's gaming, right, this is a bit more difficult to predict because gaming trends can go. Can go away in 1 or 2 years, or the game is no longer exciting, and then and the gaming industry is very competitive. So it's not exactly recurring revenues. All right. For that particular game, of course, if that company like you see like Blizzard or other companies that have different kind of games, right?
That's right.
All right. It is more or less recurring because you have a generational following.
Virtual goods as well.
Yeah. You can look at Roblox. The young kids love it. But the thing they are having some problem is if the kids were to outgrow it, would the next generation of children would they continue to spend money on that?
Yeah,
parents continue to spend money on that.
Normally it's a trend, it's a fad, right?
Yes.
And then you got to develop a new system, but not actually Blizzard has done quite well in that regard, right? They
Yes.
started with Warcraft and
Yeah.
and then Overwatch came along.
Yeah.
So I think Blizzard has a little bit of traction, but I'm not sure about the rest.
But the future of Blizzard is they're already quite big.
Yeah,
So
big.
you mean
Yeah.
it's our generation kind of
Yeah,
game, right?
our generation.
I mean,
right?
I thought as if like you
yeah,
older.
yeah. No,
We are same
I
generation.
used to play diskettes. The game come in
Yeah.
diskettes.
Oh, okay.
yeah. So it's
I
not-
play Dota also. I mean,
Yeah,
it's
it's not
also
software
same
as
in
a service.
CD-ROMs.
Yeah.
Alright, yeah.
There used to be some anti-piracy where we flip through a manual and they'll ask for the first
Yeah.
word in the third paragraph, so we had to key it in.
Yeah.
Yeah. Okay, I'm going to let you rest, okay, and let you turn the tables on me, and you
Okay.
can ask me about dividends investing,
David,
early retirement, or life in general.
life in general. Okay.
Life in general.
Okay.
Yeah.
If you were to start all over
Alright.
again,
Okay.
let's say you start all over again, and you are like a someone who a fresh grad from university.
Okay.
He doesn't have much money, maybe $5,000. That's a lot of money already.
That's a lot of
Hong
money.
Bao money. That's how I
That's
started.
a lot. I
Six-
have less than that.
$6,000.
Yeah.
I bought one stock,
Okay.
and of course it doubled.
Right. Okay.
I was lucky. But how would you advise that person who just graduated?
Okay.
Yeah.
So I wouldn't tell the person to jump into investing into individual stocks immediately, right? I see investing as a multi-dimensional game of chess between you and your peers, right? Because at the end of the day, I think society is still very competitive, and that some of us want to invest because we want to do better than other people. So it is a chess game. It is a multi-dimensional chess game between different people.
It's a game of probability,
Yeah.
right?
And so in chess, there are various forms of defensive maneuvers that you need to position yourself for absolute beginners. I mean, not for Kasparov or some of the top players. But if you were to play some really simple opening, right, that would put you in a position to be able to pick up more information about the world of investing. And so as much as I do teach early retirement and we build very bespoke portfolios, I think your first move should be one very large equity ETF, like the Vanguard World Total Stock Index, VT, and one really large bond ETF, BNDW. And if you do not know how to do your asset allocation, you do it 50-50 and you pump it into the markets, right? Focus on getting your brokerage account up and running. I think that's more important because when you get the brokerage up and running, there is a series of steps. So when I actually documented the walkthrough with my students on interactive brokers, and it's changed since the time I got an account, I was so shocked. The system needed, for example, a SingPass account for them to fetch information
SingPass,
using
oh.
my info. Yeah.
Okay.
So you have to
Quite advanced already.
very advanced, okay, and I wasn't even aware of that, and I already have an account with them. You need to get used to all that. Then the dashboard is actually very, very complicated. So starting with a 2-stock ETF is a very good way of getting started. All right. Now, what you're likely to get is you're not going to have a return like a high growth kind of portfolio, right? You're going to get something maybe 6 to 7% returns every year.
That's quite decent.
Decent. Your standard deviation will be around, I think, 14 to 16%, which means that you can sleep very well at night. It should be half the kind of volatility and beta that you get with a growth counter. So I think that's a very, very good place to start. Now, do that first, okay? Now, then on top of it, you have to educate yourself. Of course, the official answer is to educate yourself with Dr. Well, right? Signing up for our classes. But the field of finance is such that it is relatively broad, and the first thing you need to do actually is to get your maths right. I think a lot of people think that finance, straight away you want to know what you want to invest in, you want to flex, you want to, I buy iFast and make $2 out of it. That's very nice and good.
Yeah.
But like you said earlier on, the foundation of your knowledge is discounted cash flow, right? I think if your students come in with an idea of what the discounted cash flow is, how do you project future sales, how do you discount it to the present by choosing an interest rate, I think it will make your life a lot easier.
Yeah,
and you
definitely.
can then focus on your growth stocks, right? You can
Yeah.
focus on what sector to look for.
Yeah.
So-
It's all about the cash flow,
Yeah.
right? For the business.
yeah. So this is what I think the problem of the education system is. You teach people a lot of mathematics, you make them do all these equations, and they get so tired of it, and they are doing all these 10-year series. They don't really understand that if they get it right, they can become very wealthy compared to their friends, and they can be wealthy at a very, very young age. Yeah, but they're not taught that way. So they grow up saying that, yeah, but I learned all these simultaneous equations when I'm walking in the streets. No one tosses me an equation to solve, right?
Yeah.
So I think that's I think one of the problems.
I agree with Chris. For investing, to me, it's more of a probability game. Right. For us, I think we will agree that it is actually we want to minimize your risk as much as possible.
Yeah.
And for me, is to maximize my gains as much as possible. So it must be logical.
Yeah.
Right. It must be mathematically valid.
Yep.
Yeah. Looking at your risk reward.
Right.
All right. And that's how we win the game.
Yeah, that's how we win the game.
Right.
Yeah. Okay, so you got another question. Yeah.
Okay. Based on what you are looking at in hypergrowth stocks, for example.
Okay.
Do you think it's risky, or do you think that if you were to do the math correctly,
Right.
it can actually be a very smart game? What do you think?
Okay, so I don't see dividends and hypergrowth as being opposed to each other in that just because I like something, then I must hate something else. I don't think Dr. Well stands for that.
Yeah, I agree. I agree.
If Dr. Well were a religion, it would be very similar to Hinduism, where we worship many gods and have multiple beliefs. Okay, so I would like to say that I think dividends and hypergrowth investing can work hand in hand, right? I could theoretically build a portfolio of real estate investment trusts when I'm younger, when I feel that I do not know enough about the financial markets, right? I build a very, very stable kind of portfolio. Same thing, right? Sharpe ratio, 0.8, 0.6, standard deviation 13 to 14, can sleep well at night, right? Then I receive dividends, right? Then I hear about people talking about SaaS and growth investing, and I say that, hey, I want to try it out. I take my dividends, then I pump it into Palantir. It's exactly what I did, right? I pumped it into Palantir at $10.50. It is now $25. I don't think I'll ever sell it. I'm keeping it for my kids. I'll just give them 100 shares each when they hit 18 years old.
Nice.
Yeah,
nice.
So that's how I view growth investing. But I think growth investing, the longer your horizon is, I think the more powerful the compounding takes place longer, right?
Definitely.
So, yeah, so I see growth as a very, very powerful weapon in my arsenal. And of course, in the past, before the current generation of these Palantir, Tesla kind of stocks and all that, I used to be invested in UMS and all that, which were growth stocks, I think, a couple of years ago.
agree.
I think UMS is still a growth stock today. Yeah, although it's grown by a lot. So
it's already quite big. I mean,
it's big.
So we look at the total addressable market.
Yeah.
How big is their market? How much market share they have? How much room can they able to grow further? Yeah, so that's what we look at.
Yeah.
What do you think of like value versus growth? There's this talk about value versus growth. What is your opinion?
Okay, my opinion is that they're both sides of the same coin, right? Value has got its dominance, I think, before the era of data analytics, because it was very, very difficult, very, very expensive to actually get, for example, a financial ratio, tabulate it on a table, and then buy the lowest stocks, the lowest PE ratio, PS ratio. And so the fund managers that did that made a lot of money, I think about 15 to 20 years ago, right? But what happened was eventually everybody caught wind to this game, and then they started to launch all these factor-based ETFs, right? And so value died because too many people were playing value, right? And then what happened was
value to capture.
Yeah, not enough value to capture. And then growth came in. Growth is much harder to value. You have to talk about intangibles of your software, and then you got to deal with the fact that your company might not make money for a certain number of years, right? Yeah, but the people who get it right make a lot of money, and so growth dominated for the past 10 years. I think easily for the past 10 years.
So you need to know how to analyze the growth stocks.
But growth has a problem now. Growth's problem is that I think there are more people into growth than value after this decade. And the question is, what happens when interest rates go up, right? Now, when interest rates go up, what's going to happen is that companies will find it more expensive to run projects and risky projects, right? Naturally, the amount of risk that they will take will be lower because it's easier to put your money into a government bond and then sit back, right, and watch the market, right? So we do not know, like, if growth were to have a retracement, how long or how far the retracement is going to be, because the US PE is about 35, 36 right now, and Singapore's PE is about 19. And so right now, I think that if you want to play growth, you have to be very tactical, which means that at least I know that none of my quantitative tactics will work. You need to go into each individual company. Use the product and then understand the sale.
Yeah.
And then from bottom up, you build a portfolio. Yeah. Which is why my only conviction is Palantir, because it's the only stock which I have some exposure to when I was an officer with a government agency in the past. I met some of the Palantir people. Yeah.
For me, regarding interest rates and growth, of course, interest rates will hit all, no matter what equities you're talking about, bonds, you hit equities. So it's basically that the future cash flow, that future growth will be lower, right? It will also hit value stocks. Basically, it is across the board, right? But for me, I will still continue to go for high growth is because if the company can grow like 40, 50%, their interest rate is not going to hit me very much, right?
Okay.
It's going to hit more on bonds, right? If your returns are only like, for example, for bonds like 5% and the interest rate at 3%, what is your real returns? Right? You're receiving a nominal return of 5%. If interest rate is 3%, your real return will be 2%.
Okay.
Right?
Okay.
But if my growth stock were to grow like 30%, for example, or after the adjustment for interest rate, it'll be like 20% returns, for example. My real returns is still higher.
Okay.
Right? It's just the most important thing is the reason why people are cautious about growth stocks when interest rates go up is because if they never do their valuation correctly, they overestimate the valuation. They were too bullish in that interest rate will stay low forever. They are going to buy it at a high price.
Okay. Yeah.
But for me, I'm going to be conservative.
Right.
I'm going to estimate that interest rate will go up in the future. So with my DCF method of calculation, if I find that it's overpriced, I definitely won't buy it.
Okay.
But if I find that there's still value more to grow, it could give me a compounded return of like 20%, at least a 20%, I'll go for it.
Okay.
Yeah.
20% is a lot.
Yeah, that's what I'm aiming for. Actually, this year I'm aiming for 40%.
Oh, okay. Wow. Okay. All right. Okay. Well, my final question for you is, what do you think about the guys who like to go to finance forums and they like to brag about entering a growth stock at a certain price point and exiting at a higher price point? What can you say to these growth investing bros out there? Yeah.
Well, that's an interesting question.
Yeah.
The thing is, when they make money, they have they are bragging. Obviously, they have the right to brag.
Yeah.
Right. But when they lose money, they become quite quiet.
Yeah.
But the thing is, they don't have a vested interest with their audience. Right. I mean, they don't show their portfolio. What are they doing?
Yeah,
They only show that one stock.
Yeah, one stock.
Right. But for me, I think with our members, we did
cannot,
review our portfolio.
We cannot avoid that. We have to show everything across
we
time.
did show our portfolio
Yeah.
in terms of the percentage returns
Yeah.
and all that. Like for example, during the rotation from growth to value, right? My portfolio at one time was down 22%.
Okay.
Right, but now as of this date, I'm up about 16%.
Okay. Wow,
that's quite
good.
a decent return.
Very decent.
Yeah. In fact, when it was down, we were buying more.
Yeah.
Right, we were buying more. So I mean, short-term volatility doesn't affect us because we understand the company. We have a deep understanding of the company.
Yeah.
I mean, same for you. You understand your REITs. You still do well. You still recover. All right.
Yeah.
I mean, some of the REITs lah.
Yeah.
For my stocks also, I would think that they will still recover. I bought more. Their business fundamentals haven't changed. They have been growing well. So I have no problems with that.
Okay. Well, the truth is that for us, we can't go out and flex because if my students will go, yay, I got 6% dividends, everybody is gonna laugh at you and mock you. Yeah.
Why is that? Can you elaborate?
I mean, you can go in at Palantir like me at $10.50 and it rises to $25, and when you talk about it, people.
But not every year is like that.
Yeah, people will say that you're a genius, right?
I mean, last year it was a very very weird year. You don't see investors do 200% a year.
Yeah.
No, 300% a year. It is a very abnormal year. So in a normal year, we are expecting for high growth investors, for example, hyper growth investors even. We are expecting 40%, 20% returns.
That's still very good, right?
We are not expecting that kind of returns that we are having last year. So we have to be very realistic about it.
No, we can't because for us, if we do dividends investing, you typically, I mean, if you were to average like 5 to 10 years together, you can get about 6.6% yield, which is a very, very highly optimized dividend portfolio.
But Chris, you know what?
But you get maybe 3 to 4%.
Chris, you know what my high net worth friend did? he has a lot of bonds. So from his bond returns, right, he's having like 5%. I mean, some of the bank's bonds that he have,
correct.
right?
Yeah,
He invested it in Hypergrowth stocks.
Yeah.
And last year that stock made about, he was up like 150%, 100%. So that was very good. In terms of dividends, very good for him. So I agree with the combination of the strategy, right?
You see, you got to ask people like this, are you ever tempted to sell your bonds to farm into these hypergrowth investments? That is the question. Yeah, and I sort of can guess his answer.
Yeah.
Because if you're handling millions of dollars, right, like me, and the answer is normally there is a certain component that we play to get some thrills in the market.
Yeah.
But our main rice bowl, whatever we use to pay the bills, right, will always come from something with a much lower volatility.
Yeah, I agree.
That's normal.
It really depends on your risk appetite.
Yeah.
For me, I'm all into, because for me, risk is actually what you do not understand.
That's right.
I mean, that is the most important point that we can agree here.
Uncertainty, right?
Uncertainty. Actually, to me, uncertainty is one part of risk. Right, so if your portfolio is, I mean, it really depends on your own personal appetite for risk and what you understand. For me, these stocks that I'm invested in, I find that it is low risk.
Okay.
Because the rewards, the growth would definitely outweigh the risk that I can find in terms of the risk reward. And these companies are not going broke anytime. They have so much cash.
Yeah, VCs,
right?
so much
cash.
Everybody wants to give them more money.
Yeah. In fact, I'm investing like a VC. I'm investing like a venture capitalist.
That's a good move.
Right, that's a good analogy for it. We want to be early in that company, but at the same time, we take a very cautious approach. If we are very unsure, we are still following the story, the narrative, how they are growing, how much customers can they acquire, how much subscribers can they acquire in the future. Right, we just invest a small amount first.
Okay.
So as the story improves, the fundamentals keep improving, we'll add more money. Yeah, that's how we invest.
Okay.
Yeah.
All right, I guess that's it for our Q&A. I hope that people who are watching this video would have an idea about the differences between dividends investing and hypergrowth investing. If you're hoping for some sort of a debate where there's a lot of disagreement, I'm sorry. I think that I'm more than happy to put some of my money into hypergrowth stocks.
Basically, it must make sense, right?
Yeah, and only a SIF believes in absolutes, right? Remember that. Okay, thank you very much.
Thank you very much.
And hope to see you in the next video.
Bye.
Bye.